Well, good afternoon, ladies and gentlemen, and welcome to the very last seminar in the CCOVI lecture series. And we have the pleasure of having today Don Sear. Don is a CCOVI Fellow and is also at present the Interim Dean in the Faculty of Business here at Brock University. He started off as a geologist and then took the route of becoming a business guy, and so he got a bachelor's of science in geology at Concordia, and then got two master's degrees, one in business admin in University of Saskatchewan, as well as a master's in economics at University of Alberta, before earning his PhD in finance from University of Alberta. So he's taught things such as corporate finance, investments, international finance here at Brock. His research focuses on economic and financial aspects of the grape and wine industry and financial derivatives to hedge the risk of adverse weather conditions. And today he'll speak to us about cost-benefit analysis of entering and exiting vineyard operations in Niagara from 1997 to 2010, and this particular lecture has been co-authored by Chris Symes as part of his OEVI undergraduate thesis. So with that, I welcome Dr. Don Sear.
Thank you, Andy. One little correction, where you are looking at cost-benefit analysis of entering and exiting vineyard operations in Niagara from 1997. Actually, we did update to 2011, but at the time that we put in the title of the paper, it was still at 2010. As Andy noted, my co-author here is Chris Symes, who is a graduate of his Bachelor of Science from Brock in the Department of Biology. We also want to thank Wendy McFadden-Smith, who was also on the supervisory committee for Chris's undergraduate thesis, and Matthias Oppenlander and Debbie Inglis, who helped us with providing some data that we used in the study. The usual term says all remaining errors are our own, which absolves the three individuals of anything that we may do wrong here in the study. Just an overview of what the goal of this piece of research was. It was to examine the financial viability and economic sustainability of wine grape production in Niagara within the context of grape price uncertainty, and I'll talk a bit more about that as we go through the study, over the periods of 97 through 2011. And more specifically, what we look at is the financial decision of establishing vineyard production or to abandon vineyard production historically over that time period. And then we're also going to take a look at the current grape pricing situation and the financial viability of either low-end or premium grape production in Niagara within the context of the model that we use. The model that we use, this title of the study is a cost-benefit analysis, but it's a little more sophisticated than that. It's based upon a real options model of entry and exit. And this is a type of modeling that builds into cost-benefit analysis some complexities that are based upon financial option pricing modeling. It's very popular in cost-benefit analysis these days. Number of prior applications in the literature to this particular model, which is the Dixit and Pindyke model, two individuals from Princeton University. There's been a number of applications in the agricultural area, and that's what interested us in carrying out the study here in the Niagara region. There's been studies on peach production, agribusiness, dairy farming. They've applied it as well to coffee planting in Vietnam. And myself and a couple of other co-authors had carried out a study with this model based on vineyard production in Texas. One of the co-authors is Lester Kwong from the Department of Economics here at Brock University. And so this paper represents an extension of that work and specifically applying it to the Niagara region. So real options, the application of financial option-based theory in mathematics to investment decisions. And what this does in particular is it enables the capturing of flexibility within investment projects that might be very critical to their value and which is not typically picked up in a standard cost-benefit analysis. I've put down there a Wikipedia source that gives you some description of what real options valuation is. There are a couple of very good practitioner textbooks if any of our listeners are interested in looking more into this area. Particularly the first one, Real Options, A Practitioner's Guide, is a very nice text that shows how to model certain financial decisions in the context of option pricing theory. The model that we're using to apply to vineyard production in Niagara has a couple of key elements. And the first element is when we think of an undeveloped tract of land, that we can represent that potential investment as an option. So when I look at an undeveloped tract of land and I'm thinking of developing a vineyard, I can characterize that decision as one that is like a financial call option. A financial call option typically gives me the right to purchase something such as a share of common stock at a fixed price, the exercise price. So I can think of a tract of land as if it's an option to invest, where the fixed price that I pay is the price I pay for the land plus the development costs of bringing a vineyard into production. And what I get from that is then the present value or the net benefits of running the vineyard off into the future. So I have a decision. I can invest in a vineyard, pay that price, and in exchange I receive the present value of the production. At the same time, if I have an operating vineyard, I also have some flexibility. I have a decision that I can always make at any point in time, and that is to abandon vineyard production. And so what I can do there is I can give up the productive value of the operating vineyard and what accrues to me from that in exchange for selling it off. And typically we characterize that as what I receive is then the price of undeveloped land. So at some point in time, if vineyard production becomes uneconomic or unsustainable, I have the option to give it up and receive the value of the sale of the land. And these two concepts are key elements of the model. So what we're going to do is we're going to characterize land in this way. And an interesting thing comes out of this type of modeling. And in particular, what we're interested in then is that given that a vineyard is highly dependent upon the price that I receive for my grapes, then if I'm considering investing in a vineyard, I'm going to be looking at the price of grapes, and I'm going to make a decision as to whether it's worthwhile to invest in land, incur the development costs, and bring to life an operating vineyard. That decision is going to be based upon my belief around prices, grape prices, and particularly the current price. Now, we know, and it's quite intuitive to believe then, that if I am looking at investing in a vineyard and I do a standard cost-benefit analysis, and the price of grapes is right now such that it just makes it worthwhile from a cost-benefit analysis to invest in that vineyard, that I might not do so because of the uncertainty around future prices. I may hold back. In fact, I probably will not carry out that investment until the price of grapes is high enough that I make a decision and say, well, I know prices could go down, but they could go up, and the price is high enough right now that I think it's worthwhile to invest in the vineyard. And this is what we're going to refer to as the critical price of entry. So at a certain point we make a financial decision that is not based solely upon the current price and a break-even point, but rather, because of the uncertainty around prices, we're going to wait and only probably invest once prices are high enough that think of us as feeling comfortable that we're going to invest. And of course, investing in a vineyard is a long-term investment, and that's a key element of this decision. I'm not going to invest today and turn around right away and disinvest. I'm going to invest, and it's probably going to take me, as we know, about 3 years to establish a vineyard to be productive. So this long-term investment in conjunction with price uncertainty means that I will delay investing. And this is a common economic concept that is well recognized in economics in terms of investment, called hysteresis. We know, for example, that when coming out of an economic downturn, and if the economy starts improving, we notice that firms do not invest immediately, even though it might, at this point in time, in a standard cost-benefit analysis, be profitable for them to invest. We notice that investment in the economy is delayed, and investment takes place once the economy and prices are a bit higher, and the uncertainty or the possibility that prices may drop is reduced somewhat, drop below economic feasibility. And so that's a critical element of the model. We're going to solve for what is that economically rational, critical price at which I would enter into vineyard investment. And at the same time, and if I'm already operating a vineyard, I have an option again, and the option is to disinvest, to sell the land for a value, and to disengage from vineyard production. When am I going to do that? Well, if grape prices are such that right now I'm right on the border of being profitable, that doesn't mean I'm going to disinvest today. I'm probably going to disinvest once prices drop below that, and given the volatility of prices, at a point where I then feel that it's unlikely that there is a long-term economic sustainability. So that critical exit price is also an element of the model that we are after. So that's the intuition behind the modeling. The model itself has various inputs to it. One of the things we need to input into the model is the volatility of prices. In most cases, we base that upon historical volatility. We do need as well the variable cost of producing a ton of grapes produced from the vineyard investment. We also need what I would receive if I was to abandon the production of grapes, the total investment, and also what I would receive if abandoning or liquidating. I need my opportunity cost of capital. What is the rate of return that I want to receive? And then what I'm going to be doing in the model is solving for these critical prices at which it is rational to enter or exit from vineyard production. And the modeling of this, involves some complex mathematics, continuous time mathematics, which is a standard approach in financial option pricing theory. It starts out with an assumed process around grape prices, which is fairly standard. And then with that process, we know then that land, or a vineyard, which is dependent upon grape prices, its value is dependent upon grape prices, will follow a certain process called a partial differential equation. And we have to solve this thing and find the value of V. And at the same time, taking into account what the functional form of undeveloped land is. And remember that we're going to characterize undeveloped land as an option to invest in a vineyard. And so, based upon some mathematics, its functional form will look like this. And then, once we have a producing vineyard, it has attached to it the option to disinvest at any point in time, to abandon production. So here we see that the value of a producing vineyard is equal to the present value of the net revenues that we expect to receive going off into the future from production, plus the option to disinvest, to disengage. And then there's a bunch of complex mathematics, and what we're after, of course, is to solve simultaneously and find these critical values at which entry and exit take place. And they come about from 4 equations that are based upon conditions that apply to option and their values. And the 4 conditions fall out. And so what we have to do in the model then is, once we put inside our parameters, such as the volatility of prices, what our expected return is, the growth rate in assumed growth rate in prices, then we have to solve the model. And what we're after is our critical entry price and critical exit price. At the same time, we have 2 constants in the model that have to be solved for as well. They don't have an economic intuition behind them. They are dependent upon some of these other variables that are specified in the model that fall out. But the difficult part, and poor Chris had to spend a lot of time with a nonlinear optimization program to solve for these highly nonlinear equations and find, well, what would be, at a given point in time, the critical entry and exit prices. And so that's what we did. So we needed some inputs for the model, and one of the inputs, of course, is the establishment cost of purchasing a piece of land and developing it into a vineyard. And there we used land prices, current land prices, and going back in time we used farm credit statistics based on land prices to back those back out into 1997, so we could look at things historically. The abandonment value we assume to be simply the price that we pay for the land. And we do that on purpose because we know that if I, of course, invest in a vineyard, land may appreciate over time, but I don't want the return from investing in land to be mixed into the return that I get by operating the vineyard. So what I want to do is I want to make sure that I don't make a financial decision that says, oh, I'm going to buy a piece of land and operate a vineyard, and at the end of 10 years I sell the land for a great price, but actually I was losing money on operating the vineyard. But that gets clouded in my analysis because I've embedded in there the return on investment in land. So we're going to keep land stationary at whatever the purchase price is. But also in the establishment cost is the cost of bringing a vineyard after 3 years up to production. So until the point that we might reasonably have annual production, we're going to also incur the development costs of planting our vines, the trellises, getting things up and going for the first 3 years, and then the 4th year we'll have a harvest, and that's when we start things. So all the costs that accrue in the first 3 years are part of having to invest to establish a vineyard. The rate of return on investment, we're going to vary some of these inputs as we go through. We assume to be about 8%, which is a long-term average rate of return on agriculture. But we're also going to look at as high as 12% which is the long-term average annual return on the equity markets in Canada, although we haven't seen that. Unfortunately, it hasn't been that high for a little bit. The growth rate in prices we'll assume going from 0 to 3%, and that's based on historically looking at the grape prices in Niagara. We see some variation. We'll assume that that continues and goes through. And then the volatility of grape prices, again based upon our historical data, varies depending on the grape variety you're looking at, from 7 to 9%. So we'll take a look and vary that in the analysis as well. And what we want to do is we want to see how sensitive these entry and exit prices are to variations in these assumptions. And then we need the cost of production per ton. One of the things I want to point out is this model is based on not an acre of land, but a ton of production. So, of course, that varies by grape variety that I'm looking at. And so, of course, the model has some variation around that. So I might buy a parcel of land for $30,000, an acre of land, and, of course, if I get 4 tons per acre, then I divide that number by 4. And that's what's going into the establishment cost per ton. And, of course, that varies by grape variety. So everything is on a per ton basis. Cost of production per ton we take from the OMAFRA cost reports, and also Matthias Oppenlander, when we went into the premium and low-end production, helped us out with some numbers as well to make sure that we had some valid variable costs there. The grape varieties we looked at were Riesling, Chardonnay, Cab Franc, and Cab Sauv. So this just, I know you're not going to be able to read this slide, but this just shows you based upon, this was 2011 as an example, Cab Franc. This is the cost of production based on the OMAFRA report. So we grew those by an inflationary factor that came from 2009 to come up to 2011. And it shows you the type of detail that went into establishing in the first year what the variable cost of production is. And as well, these costs over the first 3 years are embedded in the establishment cost. They're added to the cost of bare land in terms of establishing the vineyard. So that goes into our what we pay when we exercise the option to invest. We pay the land cost plus the development cost, and then we get an operating vineyard from there. So here, for example, is Cab Franc, based on about 4 tons per acre. This is based on a price volatility of about 7%. The expected growth rate in prices was 3%. This was annually. The rate of return, assumed rate of return was 8%. So we're going to invest and hoping to get an 8% rate of return. Here you see from 2011 going down, the variable cost. This is per ton now of grape production based upon the OMAFRA data. And also the price that we pay to invest in a ton of producing vineyard, in a sense, and also what, if we abandon just the land price, what that would be. So, for example, you can see here in 2011, if this is bare land, and at 4 tons per acre, we're assuming about $24,000 per acre, and this is based upon looking at land prices. And of course, we know that varies throughout the Niagara region. So those are the inputs into the model, and then in each case, we solve those 4 equations, and out pops the entry and exit price. So they're given to you here. And so in 2011, it's saying that for Cab Franc, in order to be a rational investment decision at 8% rate of return, you want to see a grape price of $2,644 per ton. And if it's $1,473, you're going to start thinking about exiting. Okay? So these solved prices are not simply just cost-benefit analysis at 8%, but also they incorporate the volatility of prices and the uncertainty. You're not going to invest in a vineyard just because right now, at the current price, it just makes it profitable at 8%. You're going to wait until prices are high enough, and then it says to you, you know what, this is high enough now that I can handle that uncertainty, and I'm willing to invest. So the sensitivity analysis of how sensitive are these prices to the assumptions regarding the inputs. The growth rate in prices, if we start at 0, again using the Cab Franc as an example, volatility of 7%, expected return of 8%, and of course our variable costs will stay the same, and our cost of investing and what we receive if we abandon. And here we can see the sensitivity analysis of how those prices change if we change these variables. So if I increase the volatility of future grape prices, so if I'm thinking grape prices are more volatile than 7%, they're 9%, you notice that the entry price goes up, right? If more volatile it is, I'm going to wait till that price is higher before I jump in. And of course, if it's more volatile on the exit side, I'm going to wait until the price drops a little bit lower than what I would have before, because I have this hope, given the volatility of prices, that they might come back. So I'm not going to disinvest immediately. With growth, with assumed growth rate in prices, of course, both of these numbers are lower, right? If I think that grape prices will grow in the future at 3%, then I'm willing to jump in and invest in a vineyard, and also getting out. I'll jump in at a lower price than what I would have before, and I'll get out at a lower price than what I would have before. And then finally, if I increase my expected return, if I say that the return has to be 12%, well, of course, that's going to increase these prices in both the entry and the exit case. I will need a higher price to enter, and I'll get out quicker at a lower price. But even with those variations, we don't see very extreme jumps in that entry and exit prices. So they give us some sense about how sensitive our results are to the inputs. So we also found that the cost of production for the various grape varieties did not vary dramatically and did not have much impact upon the entry and the exit prices that we solve for. So what we did here as a very broad stroke analysis is we said, well, let's take the average OMAFRA cost for these 4 varieties, and we'll assume the historical growth of 3%, volatility 9%, so we were assuming reasonable numbers with a rate of return of 8%, and yield of 4.5 tons, which again was an average between these 4 grape varieties. And then what we did was we solved for the entry and the exit prices for the years 1997 through to 2001. So they're given there in the table. And beside the table is a graph with the green line showing you the entry prices over the years, and the exit prices are in red. And then we said, okay, let's take a look and superimpose on that now historical prices for those 4 grape varieties. And you can see that back in 1997, grape prices, and the orange here is the Cabernet Sauvignon, the blue is Cab Franc, the yellow is Chardonnay, and the green is Riesling. That in all those cases, given land costs at the time, variable operating costs, and then these other assumptions of the model. The prices were above the critical entry level. So that meant, that it was a good idea to invest in the vineyard. And you can see that that continues, and it's fairly broad range, but somewhere in the around early 2000, you can see that a lot of these grape prices crossed as late as 2007 for Cab Sauv, crossed the critical entry price. So now at that point, you're in this zone here, which is sort of in no man's land. And what's happening here is that on average, you're continuing operation, but you're not expanding. So we're not seeing new vineyard land being established and under development, or at least that's what this would predict. And you can see that by the time we get to 2011 here, some of these grape prices are starting to come down here and getting pretty close to the critical exit level in price. Okay, so this is interesting because if we take a look at, now we don't have a full set of data here, but if I take a look at acres under production in the Niagara region, just as a check, I'll notice that the growth in wine grape production, acres under production, grew from 1997 on until those early 2000 period. And indeed, right now the estimate is around 18,000 acres under production, which is pretty close to what it was back in 2005. And that's consistent with these grape prices crossing through the critical entry price. And we're in a zone where you're not going to necessarily run out and establish a vineyard, because prices are such that if the assumed volatility continues at the 7 to 9%, you're waiting until prices get a bit higher. And that seems to be consistent. So it's a little bit of a check of our model. How realistic is this panning out for us in terms of the prices that we solve for in this model? So then we said, let's take 2011, and we're going to use the current grape pricing model, which has been adopted in the region. And we're going to look at two scenarios. We're going to look at low-end production, and there we're going to assume 6 tons per acre. So of course, if I produce more tonnage, that reduces my investment cost, and of course I have a greater volume of grapes, but at a lower price. So that's one decision I have. Should I go into low-end production in terms of grapes, or should I go into premium production? And so with these assumptions, what we do is we then solve again for the entry and the exit prices, and here they are in green for the entry price, red for the exit price, and here they are in the range. And then we take what is being offered now in terms of per ton prices for Riesling, Chardonnay, Cab Franc, and Cab Sauv. And what we see is that we're not going to see a case of vineyard investment taking place, but we're not seeing abandonment. That these prices are in between the entry and the exit range. But when we go to premium grape price production and prices, So there we assume premium production 3.5 tons per acre. That means the variable cost per ton is higher. The entry and the exit prices are resolved for. And then we look at the prices that are being offered in the current grape price regime for Riesling, for relatively high Brix levels of different grape varieties. And we plot these in. And the interesting thing that we're getting from this result is that we're seeing that Riesling, Chardonnay, Cab Franc are sitting below the exit price. So a rational economic decision is to get out of producing at that point in time premium production of those grape varieties at the current prices. It might mean switching to low-end production, but it has an interesting implication for the region and the grape price structure that we currently have. Cab Sauv is still in the in-between zone. And anecdotally, talking to grape producers, we're getting that sense that on the premium production side, this is the issue. So if we want to see greater premium production, grape production in the region, the implication here is that prices are not set at a level that certainly not that would result in increased vineyard investment and production. So historically, growth of wine grape production acreage in Niagara is probably consistent with this analysis. High growth up until into the early 2000s, depending upon the grape variety that you're looking at. Grape prices generally before that time period exceeded critical entry price for investment purposes, so it made a lot of sense. The current grape price analysis, the low-end grape price production, is currently more attractive in a sense than premium grape price production. And the sophistication of this model is that it takes into account the uncertainty of the decisions. So it's not simply just a straight cost-benefit analysis. Premium grape prices are approaching critical exit price levels, particularly in the case of the Riesling and Chardonnay grape varieties. There's always some caveats. This is a very broad-based analysis. We are taking averages. So, of course, when I look across the region, land prices differ, variable cost per ton differs, and those are all idiosyncratic decisions. So, on average, we may say that premium grape production does not look economically sustainable, but it might be in specific areas. And there's individual complexities, and of course, in making the decision to enter or exit vineyard production, our analysis is based simply on an economic decision around an 8% average annual rate of return. People make decisions to invest in a vineyard or disinvest upon some very idiosyncratic things. So it's very hard to take this model and apply it down to the individual vineyard level, but it is a broad stroke analysis that points at the issue around premium grape price production that we're facing perhaps in the Niagara region. There are other sources of uncertainty that are not taken into account specifically in this model. The yield per acre, of course, varies from year to year, so it has volatility. That's assumed fixed at an average level. The variable cost per ton, of course, then is also variable. And the abandonment value, we could play with those things as well and make them variables of uncertainty in the model. When you add those additional models or variables of uncertainty, it pretty much makes the modeling intractable. It's very hard to come to solutions. But you can approximate things by increasing or decreasing the volatility on the grape prices themselves. Because if I if I presume that the yield per acre is volatile, then implicitly I'm assuming that, in a sense, that feeds into how much my net revenues are, and I can correlate that to a grape price and build that into the model. So I can capture some of those additional uncertainties, but what those additional uncertainties do is that they will in general broaden the distance between entry and exit. They'll make entry prices higher. They'll also make exit prices a little lower. They don't occur symmetrically, but they do change. So I think we've got a fairly prudent, analysis, even though we may not have explicitly modeled those variables of uncertainty. Land value in terms of abandonment has been kept constant. As I noted, we don't want to confuse the rate of return on land into the rate of return on grape production. But we can increase that, and that will narrow the difference between the entry and exit prices. As we saw, those broader entry and exit prices did not vary too much by changing any of the model parameters. That takes us to the end of the story. So we're open for some questions and suggestions on how we might improve the study.
Do you have any plans on expanding this application to some of the emerging regions?
Pardon me?
Do you plan on expanding this study to some of the emerging regions, such as Nova Scotia in particular?
We haven't planned on it, but of course it's still a study that interests us. It would be, relatively easy to do. The good thing about dealing in the Niagara region is, even though we don't have, for example, the detail of data that, for example, if you're in California, that you would have on grape prices and a lot of other factors. That, in addition, becomes less so when we, or more of an issue when we look at some of those more developing regions. So that would be the only thing that would, hold us back from that approach.
What a forward-looking perspective. Your model suggests that to get out of premium, the market today is I guess we're at the highest point of the model. Getting out today of premium going to hybrid or something less.
To a lower premium.
Lower premium product, but the marketplace does not want lower price in the marketplace.
Right.
So,
right.
How does would a grower get into it with a future perspective, and how does the model figure out? Because then you get the government issues, right, in terms of supply and demand, and where's you're making good money on non-premium versus premium.
But
how do you factor in where the market and trails go?
Yeah. Well, our grape pricing system in the Niagara region is not one that is necessarily a freely negotiated system. So you're not like it's not as if you're in California where you see the range in grape prices go from $400 a ton up to $5,000, $6,000, $7,000 a ton, and of course that flexibility allows different producers to do different things, and prices reflect perhaps more readily the demand. So you'd have to say that here the price, if the demand is there for premium production, it's not reflecting it's not reflecting in that demand right now, and we're in the danger of producers saying, well, I might as well switch to low-end production, which of course could in the long run lower prices for low-end production. So there's a decision there for the individual producer to take. The dynamics of that, you can work a little bit in models. I've seen models where the prices of grapes follow some serial correlation around that, but it doesn't add too much to the entry and exit decision. There is a game playing and a dynamic aspect there, but that would involve everybody colluding together in order for it to take place. This analysis is based on an individual producer that is a price taker, that sees prices and assumes that their own move, let's say from premium down to low-end production, will not affect prices. But of course, if everybody does, it would. But that doesn't affect their entry and exit price right now.
You mentioned this with growers, you went to get some industry input, I guess, from...
Yes, we did. We want to make sure that particularly our inputs seemed reasonable, and the idea of what could we expect on yield per acre. We did some, not a broad survey, but some phone calls around to say what's a reasonable number there for low-end production, 6 tons per acre, 3.5 for premium. Our cost per acre, we did modify this data slightly based upon, I'll just flip to it here, this data in a table like this. This is 2011 Cap Franc. We did go through and make sure, well, does that seem like a reasonable amount of labor, if I'm into the premium side? So we did adjust those costs for the fact that there would be more work being done in the vineyard for the premium production. So we made, and that was with some phone calls and getting a sense of the estimates of those costs. So then that would, you'll note here that these prices of premium production, the variable cost is $7,340 per acre versus $5,728, and I mean this is the key element here. $5,728 per acre. You're getting 6 tons per acre. It's at a lower price though, but that is outweighing the fact that you get a higher price here in premium production. But if you might reasonably only get 3.5 tons per acre in order to achieve that premium production, and your costs are as well going to be a little bit higher. And then when you take into account uncertainty of prices, so if I'm sitting right now as a low-end producer and I say, well, I'm thinking of going premium now, or vice versa, I'm thinking about there's volatility in prices, so I don't know what'll be happening, and I'm only going to do so if prices rise to a level that I feel confident then to make the investment, because the investment in a vineyard has an irreversible aspect to it, in the sense that once I do that, if I go and open up a new acre and I'm going to go high end, it's going to take me 3 years before I'm up and producing, and I'm not going to make that decision lightly. I'm not going to be switching production very quickly. I'm going to do it over time, and because of that time, that's what that irreversibility, in a sense, that's what gives rise to the concept of hysteresis, that I'm going to delay making that decision until prices are at a certain level, or get out at a certain level as well.
This is probably more of a comment than a question, just following up on something that Ian was saying. I think it would be very interesting to look at BC prices. That's, you're looking here at growing grapes at $800 per ton for plateau pricing, and what looks like about $1,300 per ton for premium. I remember a grower in BC telling me that he could grow premium vinifera in Oliver for $200 a ton because of the much lower pest pressure and the way fewer sprays.
Right. Your cost, your cost per ton.
But of course, land prices
are higher
as well. So
yes.
I think it would be very interesting
to see the difference and
to see whether it's still going to be worthwhile paying $100,000 per acre. When
even though your variable cost is lower.
Your variable costs are way lower.
Yeah. Yes.
I guess
that's a good point. Yeah. It's a lot of work solving those equations, but it may be worth the attempt.
Yeah. Well, if there aren't any other questions, I'd just like to thank you for giving the seminar, and we've got a small gift for you on behalf of CCOVI.
Thank you, Andy. Very much.
Thank you very much.